You learn how to learn. You learn how to get better. Part of the same process is applicable to investing. Every time you invest, you need to be learning. I love to crack this question: is you investing to learn or learning to invest? It better be both all the time.
Mike Zlotnik joins me again. You can find him at bigmike.com. Oh, no, Big Mike Fund. I almost screwed that up, Big Mike. Bigmikefund.com. I don't know what you find at that other URL, so maybe not avoid that one. Bigmikefund.com. Thanks for joining me again. It's been a
Thanks,
while.
Jack. Appreciate the opportunity to be with you.
So we're going to do a truncated version of this, but it's always good to hear people's origin stories. How did you find your way into real estate investing?
I'll run a super short version. So, James Bond movie, From Russia with Love. I come actually not from Russia, from Moldova, Republic of the former USSR. In 1989, I come to the United States as a political refugee from the USSR. Like most other folks from that part of the world, I'm a chess master, I'm a mathematician. I go study mathematics, computer science. I have a 15-year career in technology, from rank and file to corporate vice presidents. Successful career. In parallel, I start investing passively in real estate in 2000 in New York City, where I live, and been a passive investor since 2000 until now, as well as active full-time fund manager. I moved 2009 when it was the right time for me. I was a little bit tired, a little bit burnt out from the IT world, and it's a great platform. Certainly still love technology, still have a lot of friends. But I moved in real estate full-time, which I believe is my passion, and sort of that's how the change happened. And since I never looked back.
Yeah. Was there a specific moment or experience that made you ditch the corporate world and focus on real estate investing?
So high-tech world, my last gig, I had 5 departments, people spread around the world, nearshoring, offshoring, running business intelligence, quality control, software configuration management, and 2 other departments. Oh, security, and lots of responsibility. Things were happening day and night. It's just a lot of work. You're always on all the time. It moves fast. Technology moves fast. I was feeling that I wanted something different, something not that I couldn't continue that, but I wanted something that is a lot more predictable, simple for me to understand, and real estate appealed because I was already a passive investor for a long time, and I saw the appreciation of real estate investments. I knew of the cash flow, but I wasn't focused on the cash flow because I had a day gig, daytime job. So the natural tendency was switch, use the savings and the experience and the sort of mathematical mindset from technology to go do real estate, what you really like. And the switch was 2009, right after a great financial crisis, and we did a lot of hard money loans because deals were trading at massive discount. We were not equity players; we were debt players. It was all about income. It was all about great income. Hindsight, we probably could have done even better if we owned a bunch of these properties long term. But lending money at double-digit rates for conservatively underwritten was a pretty good gig for a number of years. We later evolved, of course, into commercial real estate and equity investments because lending was all income, not tax efficient. At some point, you need something a little bit more longer term and get some income today and also get some growth as part of these strategies. So it's been an evolution. It's not a one simple strategy, just more of a you see what works and you adjust and adapt with times.
Well, let's talk about you being a chess master. What does it take to become one? Let's start there, and then we'll move into how are some of the lessons you might have learned in that realm, and how is it applied to your real estate investing?
So all you have to do is grow up in the Soviet Union. I'm just kidding. That was a thing to do. My father was a chess master, 5-time champion of the capital city of Moldova. So it wasn't even a question. I grew up playing chess since, I barely learned how to walk. I was watching my dad, play games and study. So I just spent my 10,000 hours, in the concept of outliers. I got to that very, very fast. So you just basically, you go to school, and after school, you go for 4 hours of chess study every day. And then you come home and you do more. So there were chess schools after regular school. So I just, that's all I did. It's kind of, this was my sport, and you just enjoy it. At some point, of course, you try to take the things you learn from chess into other applications of life. And there's actually a lot of similarities and differences between investing and chess. So what chess is, it's very computable. You can compute, you can calculate. It's very, that's why computers are really good at this. There's no element of a chance. It's all about computation, preparation. You study your own games and you study the games of grandmasters. This is the best way you learn chess. You study games, you analyze, and you learn learning skills. This is the best way to describe it. You learn how to learn. You learn how to get better. Part of the same process is applicable to investing. Every time you invest, you need to be learning. I love to crack this question: is you investing to learn or learning to invest? It better be both all the time. So investing in real estate or any investing is an iterative and repetitive process. So what I've learned from chess is just to continue to get better, learn the lessons. You can lose a game, just analyze and understand what you did wrong, and make sure the next game you don't make the same mistake. Or if you learn an advanced technique, how do you apply it? Same applies in real estate and in any investing. So you understand what are market cycles, you understand leverage, you understand risk. In chess, you can make a move that has more risk, and then you can run into trouble because of this. And same thing in investing. If you take on risk, things can go the wrong way. So long story short, lots of elements of chess thinking very applicable to learning how to become a better investor. Investing does have one difference. Any investing, stocks, crypto, bonds, real estate, anything, it has an element of a chance, which doesn't exist in chess. And the element of a chance is a very important element. And through my study of investing in real estate, following Howard Marks, a study of risk, he talks about the risk is investing is not easy to quantify, sometimes before, sometimes after, because you could make an investment and it fails and you made all the right decisions, or you can make a bad investment decision and it succeeds tremendously. And then you look at the outcome, was the right decision made? So that process of basically looking at the outcomes and looking at the decisions and understanding what works, and not only looking in the past, but also trying to project the future. Quite often in investing, there's a very important lesson. The past results are not indicative of future performance. Too many investors forget, and this is even more applicable now more than ever, where certain investment strategies have done phenomenally well. There's a lot of greed there, and then the opposite happens in certain other strategies there's a lot of fear. And I always learn, one of the lessons I've learned, again, this is back chess to correlation to the investing. Warren Buffett, be greedy when others are fearful, be fearful when others are greedy. Does it apply to chess? Of course it applies to chess. Just be careful when you're winning a bunch of games and things are going well. You're not paying attention. You're not thinking about the possibilities of the next game, what could go wrong. So these fundamental lessons apply to both chess and investing.
I really appreciate that insight. That was really interesting. One of the things that you mentioned, you've been investing since 2009. With the landscape and the history now that you've experienced, is there any significant changes in what you're doing today that you weren't early on?
Sure, market cycle, right? We're at a different part of the market cycle, and there's similarities and differences. Market cycle has seen a great boom. You enter the market 2009, and the boom continued all the way to essentially a blimp during COVID. And COVID was a quick market, reset and a quick recovery. And then the market got flooded with money, and the boom continued all the way through 22. Then the market has gone through a very fast and furious interest rate hikes, and the Fed has kept them higher for longer, and that reset the market. So one of the basic observations, these market cycles do exist, and what you do at the beginning of a cycle is different than what you do, in the middle of a cycle. So again, let's talk about the cycle. The cycle has 4 phases. It has recovery, expansion, hypersupply, and recession. These just are 4 terms. There's other ways to call them, but you understand the basic concept. So the strategies shift, at least from your capital investment in real estate. What should you do at different phase? So just taking a pause for a second, now there's a lot of similarities to 2009 because it's right after significant market correction. And now it feels like we are about to enter a recovery phase or have started recovery phase as interest rates come down. Real estate is very sensitive to the interest rates. So the concept is typically in late stage of the cycle, when there's a lot more risk, you typically go to private credit, more debt-oriented, you take less risk. And an early part of recovery, you take advantage of potentially better opportunities. You need to look for deep value, income oriented. Well, let me leave income oriented out of it. You could do deep value, non-income, but deep value deals where you are buying really, really well, great discount to the intrinsic value, great discount to reconstruction cost. But you're also looking at equity versus debt because equity has a lot more upside through a recovery phase and then an expansion phase. So a little bit of that. It's not an exact science, but it's a directional. And then of course, you have to pick and choose. It's all local and it's all deal specific and who you're investing with. So these type of concepts apply. But the thinking where we are in the cycle is very important, whether you take action, or you sit in your hands, or you to try to get rid of everything.
Well, talk a little bit about what your focus is right now. What are you currently investing in, or what is your primary strategies?
So today we're very, very focused on downside protected low risk because we don't know exactly what's going to happen with multifamily. Multifamily is one asset class that's beaten up pretty hard during the reset. And without going into the history, it was a very popular, wonderful asset class. It's had its problems during COVID. As market reset, values are down 20 to 40%, but the system has a lot of distress built in. So on the multifamily front, we don't know if it's the bottom of the market because a lot of people borrowed with floating rate debt. And then there's a lot of oversupply, a lot of overbuilt. So some rents are still going down. So we see multifamily as a potential next phase entry point. But what we do see is doing really well and has very limited supply and strong political support. So industrial is one strategy, especially absolute triple net industrial. We also love open air shopping. Supply has been very limited. They haven't built those plazas. And if they're located well, people still go shopping, especially experiential real estate. So we're not talking about orders on the Amazon. That whole story has been, it's a scare tactic, has never really worked for a long time. So people still go out in the post-COVID world, service-oriented. You got to get your, spa, your nails, your haircut, enjoy your local restaurant food. All that continues to be, right? Industrial is a super interesting area today because tariffs, domestic manufacturing is very, it's driving business to the United States. Produce here, whatever it is. And then interest rates are still relatively high. So can you buy these deals at relatively high cap rates, which means lower prices because they work in the opposite direction, and finance with the strong positive spread? One of the margin of safety concepts today, if you look at our underwriting box, I have three primary sort of requirements for a box, our underwriting box. One is I want to see at least 2% positive spread between the cap rate and the interest rate. So we're looking at a deal right now, absolute triple net industrial. And what is absolute triple net industrial means the tenant pays for everything. So the landlord owns the asset. The tenant pays for taxes going up, for insurance, for roof repairs, for pavement, everything. So the tenant it's kind of for the entire property, all the upkeep and all the cost increases a tenant. So as a landlord, your job is just to underwrite the tenant. If they're high credit quality tenant and they have a strong 20, 25-year lease, they've been in the business for many, many years, you can create essentially very predictable cash flow from day one because you have a strong unlevered cap rate, right? Well, what is a cap rate? It's unlevered rate of return. Then you put a leverage with a positive spread. So you cash flow well from day one. And then every year, typically these rents go up between 2 to 3% programmatically. It's a contractual requirement versus multifamily. People project 2 to 3% a year growth. And then you see what's happening in like a Sun Belt. It's negative 3 to 4% today. So will it recover? I hope so. But the point is that stuff works so predictable. And when we do open air shopping, you have Starbucks as a tenant, Cheesecake Factory, and other corporate guarantees companies that just do work very well. And can Starbucks close a store? They could, theoretically, but they're still going to pay the lease. If you have a 10-year lease with Starbucks, they're going to pay it for 10 years, even if they wanted to exit the location, in a matter of speaking. So what we find that these strategies are just so much more predictable in the form of cash flow, in the form of forced appreciation because of these rent escalation clauses, and a very simple strategy forward. So we find them to be extremely attractive. And if interest rates come down through Fed rate cuts and other factors like AI, AI is highly deflationary. Investments in AI expect to increase productivity, and some people will lose jobs. So anti-inflation or deflation or slow inflation should actually help to lower interest rates in a matter of speaking. So for those who study these type of things can actually appreciate the benefits of AI. So as interest rates come down, some people don't believe that they will come down. In my view, they will, at least in the short term, right? We're going to see significant tailwind to these strategies because things are sensitive. So if you're buying at 8.7 cap rate today and you're financing at, let's call it 6.7% mortgage, interest rates come down by 1%, then the 8.7 will look like 7.7 cap rate and 5.7 interest rate. That 1% compression in the cap rates has a lot of upside to investors because the new buyer is paying significantly higher price per dollar of income because they're financing at a lower cost of capital. Pretty basic math. Talking about Chet being chess and mathematician, this stuff is in my head like a second nature. But the reason we find it so attractive is I actually believe AI will revolutionize the world and it will be anti-inflationary because by definition, these type of leaps forward create phenomenal automation productivity, and they actually cost a lot less to produce a unit of work because of a technology enhancement. And that lowers the cost, and that's deflationary in nature.
Yeah, if you found this information interesting, I would definitely direct you to bigmikefund.com, learn some more information there. If you found some value in what we're chatting about so far and think that one of your investor friends might find this useful, please share it. It's the only way that this show continues to grow. And if you're watching us on YouTube, feed that algorithm. A like and subscribe goes a long way. So, Mike, you were talking about a 2% spread or 2-point spread on between the cap rate and the interest rate. Are you finding these as readily available deals, especially in that industrial space, or maybe you're even seeing better deals at the moment?
Yes. So this would not be brand new data centers. So this would not be some of the properties in Sunbelt. So we're finding these deals more of a Midwest type of smaller assets where you don't have massive amount of capital creating competitive pressures. So, deals with U.S. domestic steel manufacturing or some kind of other production, we are finding quite a bit of deal flow in the, let's call it 8 to 9% cap rate range. It does exist. There's not a shortage of high quality smaller businesses that get acquired by private equity and real estate needs to be sold and they just want to continue to invest. So the short answer to the question, we are finding these deals, and that's why we're so excited about it. Now, if you're going to go to certain parts of, South or some other biggest cities, New York City or LA or Miami, you're going to find much lower cap rates, and this is the reason the cash flows don't work as well in these lower cap rate markets. So we're just looking for the markets and the opportunities that do have the 2% positive spread. It's not everywhere. The other thing that we look at is obviously reconstruction cost. What would it cost to build a similar type of an asset? So, of course, new construction would have all kinds of new technology, and you have to discount for the age and wear and tear. But it depends on what the business is, right? For some businesses, new high tech innovation is inevitable. But if you're basically in a commercial box shell where you could add a lot of other things, or the tenant could add, then of course the investment itself could be well below reconstruction cost if just to rebuild a similar shell. Now we're not talking about adding all kinds of efficiencies and automation and solar panels, all that stuff in industrial. The tenant wants to do it, be my guest. Let the tenant make the investment. The one thing we've seen on some of these deals, the tenant may want a new roof, or they may want something else. So they may approach to you and say, you guys capitalize those improvements, but we'll pay for it in the form of a higher rent. So those type of conversations do take place. So those are the two requirements. And the third requirement in general that we have is we want to discount to the peak of the market, right? So 2022, when the interest rates were at the lowest, the cap rates were lower, can we get 20+% discount, right? In multifamily, we would look for 20 to 40% discount. In industrial, it's not easy to get because a lot of demand for these assets. But because the interest rates are significantly higher, you're still getting that cap rate expansion. So the cap rate math, that general framework still holds, and you got to have some level of flexibility. So when I say 2%, if I got we were looking at another deal not far from New York City, and it happened to have 1.5% spread, right? So you have to adjust it to the market. So 2% is a rule of thumb. I still want the positive spread, but if I'm in a better market somehow and I want to be at a little bit lower spread, it's a possibility.
Yeah, I was going to ask you, how do you balance that? Whether, you've established that buy box. We have, as investors, we have a tendency of sometimes trying to chase that deal, or we get addicted to the deal, and we might bend our buy box to create something. Like, do you try to stick to things, or are there other levers that you take into account to justify a lower cap rate?
Sure. So the buy box is always intended to be a guide, right? Well, ultimately, what you're looking for is a deep value. You're looking for downside protection, and you start going through other elements. So it's not all about the upside. It's about we are capital partners. Just to be very clear, we don't operate these assets, but we have partners who we've known for a long time, and we know that they're deep specialists in their strategies. So when they bring us a deal, the deal is already pre-vetted, and we go look at this. Sometimes we go look at 2, 3 deals, and we'll just select one, which we like most. So our buy box is well defined. We have a very significant don't buy box. So just to be very clear, our don't buy box, don't do anything ground up. I don't do any heavy redevelopment today, too much risk. And if we can buy existing at a discount, I'd rather do that than a construct new. So we have certain elements of don't buy box, which would, no matter what you're going to tell me, I'm just going to say it's not for us. On a buy box, it's approximate set of rules. The location, of course, matters. Who is the tenant? So if you look at this and the tenant happens to be better, higher credit quality, you might wind up settling for a little bit lower cap rate. So none of this stuff is extremely rigid, but at the same time, we're trying to move towards a target. Does this make sense? It's more of a directionally, this is what we would like to do. But if you show me a special circumstance a little bit off, there's a margin of variance in all this, in all the thinking. But what I don't want to sacrifice or compromise is on downside protection. I still want conservative leverage. I still want fixed rate debt. I want optionality if interest rates fall. What are the prepayment penalties? Also, obviously, one of the most important underwriting credit profile of a tenant is an example in industrial. Things are different in different strategies, but these concepts do apply to industrial open air shopping very, very similarly, because long-term tenants, credit quality, you're looking at the institutional quality, everything. Versus, like multifamily, I've seen a lot of non-institutional owners, and it's all the guidance, all the buy box, all the rules are not written in stone. Today, these are the rules. Tomorrow, things may change a little bit. And that's an important element. You have to change with times. I mean, I'll just tell you this, right? We're in real estate. I'm a fundamental real estate person. But at the same time, people have showed me some really innovative ideas. Some people are using Bitcoin and real estate together. So I'm studying, what does it mean? How can it work together? Again, I'm not a Bitcoin guru. I just understand the basics of it. People talk about limited supply, but at the same time, the price is high, and people talk about all the potential upside. Okay. And there's a lot of money in Bitcoin. People have made great returns. So I'm just giving an example. I'm studying, can I put those things together somehow? Does it make sense? Still, fundamentally, I'm a deep value investor in real estate. And can there be other technologies, AI edit, and whatever you want to call it, to enhance what we do? Absolutely.
You were talking about industrial, and you mentioned open air shopping areas, and this could be just in my neck of the woods, but it just doesn't seem like that some of these assets are recovering from the whole COVID shutdowns. In fact, we have like strip malls and a few other things that are still vacant. Are you seeing a recovery in other parts of the country? Or what do you think is going to come of some of these assets that just remain empty the way they are?
So all real estate is local. Not only it's local, it's really a function of very sub-local dynamics. I'll just give you an example. So I have some family upstate New York in Rochester, New York. I live in New York City. And I every time I drive, I see Marketplace Mall. Marketplace Mall was a great, wonderful, big mall. It used to be awesome. And then it's pretty much all deserted. And you have, like a Sears space converted in like RPM racing. and you have another parts converted to something else. But beyond that, the rest of it is completely empty. And then you drive just 5 minutes away to an open air shopping plaza, like literally 5 minutes away. It's very, very close. And it's busy beyond belief. So people shifted all their shopping patterns to go to that open air shopping area, and there's no empty spaces. Everything is busy booked, and you just kind of, you do your basic, walk around, and you say, this place is just awesome. And why it happens is because they got a bunch of restaurants, they got still wonderful discount stores, they've got some really, Starbucks out parcel, and a bunch of other things. People still want to come out and do it. Will we ever get away from local service-oriented retail, local experience? I don't know, but people, they're still people. So what we do find, these projects are all local. It's like you have to look at every opportunity, local dynamics, what's happening, what is a long-term trend in that given area. Do you feel like it's going to continue to do well, or you think people are just going to, I don't know, move somewhere else? Or you think people are going to order everything and we're going to get drone delivery and people just not going to go out, they're going to live in their apartments and houses and be stuck. So it's kind of, what do you think about the future? And we still see the future, human is a human. So these open air shopping have done really well, and they're going to continue to do. Now, location matters. People still want to drive not too far. There's still some local effect. So if you open a wonderful open air shopping too far away, people are not going to go there. So that's why real estate is real estate. That's why there's a value for the land that it exists. So how do I think about it? I just think about every decision has to be very, very specific. And I would not touch many of these enclosed malls for the reasons that they just, once it's dying, it's dying. It's just, you can repurpose it. You can open a self-storage facility or RPM racing, on all big box. Can it be turned to industrial? Yeah, possibly. If somebody wants to have a warehouse in that. There are repurposed strategies that are worth consideration for us today. We're not doing too many of them, although we've done investments in the past and conversions of big box into storage. Some people talk about office building conversions to multifamily. The complexity is these are not easy to convert. Plumbing, electric, there's all kinds of other complexities. So it's not for us. I'm not saying these are bad projects, it's different. So what we like is today, simplicity and ease of underwriting. As much as we can, we want cash flow, we want downside protection. Will these things still stand 10, 20 years from now? That's the question that we ask ourselves.
So those people that are listening to this and they're thinking, oh, this industrial investing, this might be my ticket to enter real estate investing. What would you say to them? Where should they start?
So as I said earlier, invest to learn to invest. So of course, do a little bit of research, whatever you need to do. There's some articles, there are publications on the trends, etc. But at some point, you just got to start. I mean, at the end of the day, you got to, in any investing business, and we do exactly the same, you always pick the jockey ahead of the horse. It's who you're investing with first. So you got to develop know, like, and trust with whoever you want to invest in. You want to get confidence that they're going to put you, hopefully, in a great way. They're going to get you into a great asset, and you're going to have a good investment journey. And continue to learn along the way. Do your due diligence, do your underwriting, do your reviews. A lot of people try to spend a ton of time and try to get perfect and learn everything about everything, but it's hard to do, right? You could be a doctor, a dentist, an IT executive. You can learn everything about real estate. At the end of the day, you're going to have to build some trust and write somebody a check and then see how it goes. Diversify over time. Don't write don't put all your eggs in one basket too fast. So write a check and see how it goes and learn from the experience. That's a way to start. And then if you have good experience, you can write another check. And the reason you need to diversify in time is because sometimes markets go through a cycle and you don't know peak of the market or bottom of the market. So we do the same thing as investors because of our model, how we operate. We try to establish these relationships first. We write a first check with somebody, smaller check, and then we see how they do, how they report, how they answer questions, how they respond. If you see quality, how they distribute, do you get your distributions? Of course, there could be a little variance. Of course, there's a little bit of, things could go a little better, a little worse, but you're looking at, it's not about pure numbers. It's the people. Are you enjoying working with these people? Are you learning, interacting with them? Are you having positive experience? And you're making a return on the way. By the way, every return number, there's a range. There's always a variance and a range. So when you look at an industrial deal and it has a 15 to 16% IRR target or return target, internal rate of return for those people who don't know, it's a better way to express sort of a compounded rate of return. So we say 15 to 16% IRR. If you doubled your money in 5 years, which would be 20% a year average, but you got no cash flow in the way, your IRR would be around 15 to 16%. Now, if you got some cash flow in the way, it's a complex mathematical formula, but at the same time, it describes kind of the performance of the deal. So 15 to 16% IRR, one of my most basic questions, part of our own underwriting, what happens if interest rates go up or down a little bit? What other variance could happen? We call it sensitivity analysis. So you're sensitive to certain variables. And then you go look at it, okay, my 15 to 16% could go up to 20 on the upper end of the likely range, and maybe down to 12% or 11% on the lower end of the likely range. Is that bad? No, it's a reasonable range. So today we're looking for good type of deals with downside protection and having some level of variance that's not too high, not too wide. The key word why I am in real estate is predictability. I'm looking for predictability.
This has just been a great conversation. I have one more question before we jump into the rapid fire. But before we do, I just want to remind everybody again, bigmikefund.com. You can learn more information there. But my question is around scaling your business, Mike. You've been doing this since 2009. Likely have hit some bumps in the road as you scaled your business. What was one of the biggest lessons learned and how did you overcome it?
Yeah, it's a great question. One of the best lessons I've learned, and again, it's kind of a ridiculous basic statement, is to continue to diversify. We observe we've done a little bit too much in certain strategies like multifamily, and when they go through correction, you take a couple of punches, right? So folks should always maintain very prudent diversification and diversify in time. So as basic as it sounds, I'll sound like a broken record, or this is what everyone teaches. Folks should always have sufficient publicly traded, liquid instruments. Real estate is inherently liquid. So one of the lessons learned is, of course, maintain more liquidity, diversify, do a little bit of open air shopping, a little bit of industrial, see what other strategies you may like. You may want to do some debt. So it's all about building a diversified portfolio, and don't do it all in 1 year. Put some money this year and then wait, maybe do some more next year and some more next year. So over time, talk about scaling. So the scaling component is making sure your portfolio is resilient over time. So you're scaling because our business, we're in a money management business. We're managing capital. So the most important thing is to be able to preserve capital, downside protect it. And then we've always operated in a virtual manner. COVID hit, never been an issue for us because our team is virtual. So scaling for us is relatively easy. If we had to add more people, people can work from home. So I certainly love that concept. And it's kind of interesting that if you're investing in office space, you want people to back in the New York City or whatever the market, you want them to back in an office. I don't believe that's a great fundamental long-term trend, even though many, Jamie Dimon, JP Morgan Chase, they built $3 billion building in New York City and he wants everybody back in the office. The reality is people prefer to work from home as much as possible. So some of these fundamental trends, that's why we don't do anything in the office space, for the reason that I don't know what's going to happen. Maybe the $3 billion building they built will be half empty in 10 years or 5 years. So certain things, I have more concerns with. It's a personal opinion and you can have a different view of the world.
Sure. Well, this was great. Again, Mike, do you have, before we rapid fire, is there anything else we should have tried to hit on here today?
No, that's about it. I do have a book coming up. People can go back to the bigmikefund.com and should be able to sign up for the book. And still working on the title of the book, but as book evolved, it's all about real estate. But ultimately, it's going to be a book about real estate investing in the eyes of a chess master. And that's simple.
Well, I look forward to checking out that when it becomes available. And, well, if you're ready, we'll jump into the rapid fire and close out this episode.
Let's go.
What lie do real estate investors often tell themselves?
They cannot lose money. People think it's perfect, but every investment has risks. And you have to be very, very mindful that even the most conservative downside protected investment, something can go wrong and you can lose money. That's why diversification kicks in. And that's a lie that you can't lose money in real estate. In fact, you can lose money in anything.
If you could go back in time and give your younger self a piece of advice, what would it be?
That's a great question. I would say, as crazy as it sounds, I would say diversify more. And sometimes you don't know what's going to be a home run and what's going to be a strikeout. So I'll give you this example. I had struggles as a fundamental investor, follow Warren Buffett, Charlie Munger, Ray Dalio, Howard Marks to buy Bitcoin early. And I had friends who told me about Bitcoin when it was $50 a Bitcoin, and I waited too long to acquire some Bitcoins. I'm not a Bitcoin, maniac at all. But diversification, I should have done some more. Go back and just don't put all the money into what you understand. As much as it's attractive to you because you operate, you know this, right? So to me, I put too much in real estate. Real estate has seen some corrections. So, but I go back and I think about it, and I know my friend, he has insane amount of wealth because he just believed in Bitcoin and he understood Bitcoin. And again, it can crash and go to zero again. I don't know that, but diversification is ultimately the better lesson over time.
Do you have a book recommendation, or what are you reading right now?
So many books. I'm just going to mention a couple of books I'm reading, and I'm enjoying many books. So there's a classic book, Richer, Wiser, Happier, about some of the greatest minds, including Charlie Munger. There's a book, Play Nice and Win, Michael Dell. There's a book these are the books all that I've read, and I'm rereading them. I actually listen to books. I use Audible. There's a book called Sometimes You Win, Sometimes You Learn. Very, very important. Let's see. Howard Marks, Mastering the Market Cycle. Ray Dalio's Navigating Changing World Order. The Principles of Navigating Changing World Order. The Principle of Navigating Big Data Cycles. All those are very fundamentally solid books to just, if you love investing, you're going to enjoy all these things. I also read some fiction. I go back and I read some really old for entertainment. Different people have different things. I grew up in the Soviet Union. I go back from time to time and re-listen to The Hunt for Red October. How crazy is that? Clancy, right? So it's, depends what warms your heart. I also really enjoy sometimes astronomy and some of those kind of discussions. So you got to have a little bit of everything. Charlie Munger was a really big one, just expanding your knowledge, not in just investing, but in other fields, because it gives you well-rounded thinking. Whatever warms your heart, whatever kind of gives you can have fun. But these are some of the recent books.
And finally, what single process or tool have you implemented that has had the biggest time-saving impact?
AI tools. So 2 tools I'm using quite a bit. I'm using Perplexity today. Helps research and just some ideas. And then using ChatGPT to help as a first-time editor of the book. So these AI tools is just still a ton of work in process. There are the tools that take notes, obviously, on calls. And so these are very simple tools, very basic and very significant investment return, productivity, etc.
Have you tried the Perplexity browser yet, Comet?
I have not. I've been notified multiple times, and I'm sometimes a little too slow. I will, of course, try it, as it's supposed to be essentially an agent for you and a bunch of agents and do things for you. So I'm looking forward to trying it out. So I'm aware of it, and I'm sometimes a little slow adopting these things. But, it's kind of like that there are front adopters who are people on the cutting edge, and then there is old folks who do real estate. Yeah, you get used to doing something, and there are other tools. There's Claw. There's so many other ones. People keep telling me, try this, try that. We only have finite amount of time. So at some point, we have to figure out what works. This is one of the biggest challenges. I've spoken with my friends, IT. And you know what they tell me? So many like coding tools. They write down a bunch of code and that stuff has to get QA'd. Then they have to figure out, is this the right tool, that tool? So many changes. And I don't know what's going to win out there, but having, I would call some folks on your team who can try a bunch of things and then figure out that is effectively going to work for your organization, your way of thinking and doing business, and try and just be prepared. Things are going to change again, and they're going to change a lot. And if you're not prepared for that, you're going to get stuck.
Yep. Well, and I'm going to probably point everybody to my other channel. Go to RealDealCast, and that's actually what I do. I compare some of these tools in real time so that you don't have to waste some of your cycles trying to figure out what is best. And actually, I'm about to release an episode comparing all of these AI browsers, whether it's the new Perplexity Comet. ChatGPT released in their browser yesterday. We got Dia, and Google Chrome even has Gemini baked in. So I'm going to do a comparison on that and see what we can do with it. But you're right, Mike. These things are changing at a unbelievable pace, and it's sometimes just hard to keep up with all of these things. But
That's why it's so important. It's so important to have a good guide. Honestly, like we have some team members who are actually pointing to the sites with this research and maybe your show and other ones where if you get a little bit of somebody else does all the heavy lifting and at least gives you a little guidance, makes your journey a little easier.
well, again, it is bigmikefund.com. Clickable link in the show notes. Really appreciated your time. It was great to catch up and hope you'll come back again sometime real soon.
Thank you so much. I appreciate the opportunity to be here.